What about the 50p rate? Obviously, very controversial. Potentially, and I think the mistake people can get into if they're close to this, and the mistake that the danger is that Treasury gets into it. However many reports you produce from HMRC or the Office of Budget Responsibility, people still see it as a tax cut for the better off, paid for by a granny tax, and that is not what it is. But I think they just need to get some of this information out there. So this shows, I think, the quite extraordinary picture in terms of the proportion of income tax revenues paid by different groups. So reading across from the left-hand side there, we've got astonishingly, more than 45% of income tax payers are on incomes of £0 to £10,000, and perhaps unsurprisingly, on that income, you pay a very low proportion of all tax revenue. So only 8% of income tax revenues come from that. Go to the other end of the scale, 150,000 and above. 1% of income taxpayers, roughly 300,000 people, account for nearly 30% of income tax revenues, and that is a picture that will not change significantly, if at all, as a result of the cut from 50 to 45. So, this whole argument about those with the broadest shoulders have to pay the biggest share. It is the case already that that happens. And when the talk was of a tycoon tax before the budget, nobody should pay less than 20% of their income. Well, the average amount paid in income tax and national insurance by people on 1 million and above, which was what Nick Clegg had in mind, is something like 36% of income. So there aren't that many people, I don't think, who achieve tax rates below what that tycoon tax would have been. So you need to get information like that out there to justify politically justify a cut in the top rate. And we look at the rate of tax. Now, just to explain this, the black line there is Britain's top rate of tax at the moment, pending the cut to 45 pence. The sort of wavy line is the average for the G7. So you can see that the average for the G7 is under 40%. And the average for the G20 and the EU 27, the EU members, is closer to 35%. So, a 50% top tax rate was clearly very high, and even 45% would be above the G7 average, above the EU and G20 averages. And this, this puts this in another way. Just shows where we are at 50%, and you can see the composition of tax changes as well, because most go, if you take the example of Japan, where it does have a 50% top tax rate, but that is not all central government. I mean, some of that is local government, but it's not an important distinction. But I think the 45p, given the arguments presented yesterday, given the lack of a hint about going back down to 40 pence, I would be quite surprised if there is any further move beyond the cut to 45 pence, because I don't know if you followed the arguments, but the whole argument in the budget about the case for reducing it from 50 to 45 was all this work which suggested that if raising the top rate from 40 to 45 brings in a decent amount of revenue. So that, if you like, 45 pence was the optimum top tax rate you could have. Raising it beyond that from 45 to 50 kicks in lots of tax avoidance, raises nothing in net terms, maybe negative. But that 40 to 45 still raises some money. So I think, having used that argument, quite a lot of new evidence will be needed to get it back down and to abolish it entirely, to get down to 40 pence. So I think we may be stuck with a 45 pence rate, top rate, for quite some time to come. I think that's certainly the coalition compromise, and it may be it may be the way we stick now at a time when some of those, despite this chart here and the one before, some countries are clearly talking about raising top rates, including, depending on which way the French election goes, there's talk of some very high top rates there. So 45 pence, may be as low as it goes, I think. What about the corporate tax regime? Well, I think this is very interesting because, this is building in the planned cut to 22%. It's obviously assuming that, and I hope people at the back can see this, but what it shows is that if you take the whole of the G20, then only Turkey, Saudi Arabia, and Russia have lower corporate tax rates. I think all of those countries have certain challenges that you might think of, but in terms of other advanced countries, we do have a very competitive, and moving towards a very competitive corporate tax rate, which I think I think the UK needs, because we've got other things in which we don't have such advantages. But this, I think, is a very important signal, and I think the government has probably been right to concentrate on that, because particularly as far as inward investment is concerned, that is the thing that people look at. They look at the headline rate of corporation tax, then they get down to the detail, national insurance and all those things. But it's a very important signal to have that. And it will be, easily the lowest rate among advanced economies and almost the lowest rate in the G20, including those others. So I think that is actually very, very beneficial and will pay dividends over the medium term. I mean, I think a lot of these, the instant analysis which says, well, it's not doing much for business investment, and people try and model that. It's too complicated to do that. It sets a mood, it sets a tone. You can't plug in a cut in the corporation tax to an economic model and say it leads to X amount of business investment. It's all about sort of encouraging those animal spirits, making business feel loved, attracting inward investment, and so on. And I think it probably does do that. What about the economic outlook after all this? How does it affect the British economy? As I say, the uncertainties are there about the global economy. Global economy is very important to us. But some of those uncertainties are starting to lift. I mean, particularly, I think it's very encouraging what's happening in America at the moment. The American, ever since that downgrade, ratings downgrade that America had in August, things have just looked better. Most economic numbers have surprised on the upside, particularly the employment figures. America is adding something like 250,000 jobs every month. It's doing a lot better than it was. Obviously, all that's come at a good time for the president in election year, but it's good for us. I mean, we don't necessarily follow the American economy slavishly, but I think there is an element of where America leads we follow. So I'm quite encouraged in what's happening there. It's still a big story about rebalancing the economy, and this just looks at over the next including this year, over the next 5 years, where the growth is expected to come from. And as you can see, investment is expected to be stronger. Exports or net trade is expected to contribute. Government, having contributed quite a lot to economic growth over the 2000s, is going to be a net drag on growth in quite a big way, as will consumer spending. So consumer spending will start to rise again, but it won't. Its share of the economy will decline. And I think the interesting question, perhaps particularly for this audience, is what does that mean for financial services? Now, I think the Treasury included this chart. I thought it was just fascinating, this chart, because the Treasury obviously included it purely as a criticism of the last government, because it takes the period, conveniently, 1997 to 2010, which was the period of the Blair, then Brown governments. And I found it quite striking, because I've always said that, however people tend to exaggerate the contribution of financial services to the economy. It's 8% of GDP rather than some people think it's 20 or 30 and so on. But you can see, I think it is quite striking, the narrowing of the gap between manufacturing and financial services. To the point where, and slightly distorted numbers because of the recession, but to the point where in 2009, in terms of their value added to the economy, in terms of their contribution to the economy, financial services and manufacturing were neck and neck, and it's moved away slightly since then. But it is quite a striking comparison, I think. And, does rebalancing the economy, encouraging more manufacturing, does it mean it has to be at the expense of financial services? I'd suggest not. I think not hugely. I think the core share of the economy for financial services is still going to be around 6 or 8%. But then the question will be whether you can encourage manufacturing to grow. But I just thought this was a fascinating chart, just showing how, in a relatively short time, there's been this quite dramatic shift in relative shares. This is the latest projection, and obviously, again, just a few weeks ago, the big concern was over, we were going back into recession. Fourth quarter was very disappointing. First quarter, not going to look any better. And you can imagine how, confidence sapping it would have been if we'd gone back into recession. Now, I say if, the official statisticians, the Office of National Statistics, is a law unto itself and is still quite capable of producing a negative number for the first quarter. But all the surveys and most of the data suggest that won't happen. This is the forecast from the Office for Budget Responsibility. And, it shows, as you can see, a steady pickup in the rate of growth. This is still rather unspectacular. If you trace those numbers across, if we are growing in line with our long-term trend, we'd expect to be growing by around about 0.6%, 0.7% every quarter. During 2012, it doesn't get to that. Even on an underlying basis, it's kind of 0.3, 0.2, 0.3, 0.4. And so this is not yet a recovery that has probably properly established itself. And again, I was saying to James earlier that you contrast that with the period of recovery from the last recession in the early 1990s, and by now we were achieving 3% plus economic growth. At the moment, it's struggling to get to half of that. So, but avoiding the double dip is important. There is, as you can see, a bit of a zigzag there, which is what the Office of Budget Responsibility expects from the official numbers. And these are all these things that we, the special factors that affect an economy when things are quite weak and sort of not that much above zero. So, we remember the snows of the end of 2010, which gave us that fall in GDP. Remember the royal wedding of last spring. The extra bank holiday in June will complicate second quarter GDP, but the Olympics will add to it. And even if the Olympics aren't an enormous success, they will add to it because there is a statistical effect there, which I won't bore you with. But these make it. These mean that the headlines will sometimes be very positive, sometimes be somewhat negative, and these special factors have something to do with that. Business investment, as I say, people were trying to say, well, this corporation tax cut can't be worth much because it doesn't boost business investment. You can see there, this compares the 1990s with now. Actually, in the 1990s, again, then business investment took quite a long time to get going. There was a big advantage at that time of a big fall in the exchange rate when we came out of the European exchange rate mechanism, but businesses were nervous and uncertain for quite some time. So, although it's easy to say that this is unusual, the caution that businesses have, Maybe we'd be looking for something a little bit more strong later this year. But so it has been, it could be stronger, but this is not necessarily, out of line with previous experience. Business investment sometimes and quite often does take time to get going. And when it does get going, we can hope, given all the cash that many businesses have got, that the pickup is somewhat stronger than these official forecasts. The big thing I think that needs to happen is happening is the fall in inflation. This is the Bank of England's famous fan chart. I mean, I always say about these that it's a good way of doing economic forecast because you'll never be entirely wrong. So the bold red bit in the middle is where the bank expects inflation to be. So we've been above the 2% target for a long time. 5% inflation, which we had as recently as September, against 2% earnings growth is, a recipe for consumers not spending. I mean, so in 2011, after the recession formally has ended, real incomes fell at their fastest rate in the post-war period. So, this unintended squeeze on consumers has meant that, consumer spending has never been as depressed as it is at this stage of an economic cycle. So, and I think the key to unlocking that and to getting consumers spending more strongly again is low inflation, which restores the growth in real incomes, makes people feel more confident. I think it's starting to show through as inflation falls. So we're now just below 3.5% inflation. It is on the way down. The oil price is a risk to that, but as long as it continues to come down, I think the second half of the year will look better for consumer spending, and that needs to happen.